In one of our videos, we spoke about something that resonated with a lot of you. The idea that wealth truly explodes once you cross 1 CR mark. But we also warn that this journey is not automatic. There are traps along the way that can delay or even destroy your compounding engine. Many of you asked in the comments a very important question. Once I've reached that stage, what next? Shouldn't my portfolio itself start taking care of me? And that is exactly the point we raised. After a certain milestone, your portfolio should not just be numbers on a screen. And why does this matter so much? Because the market is unpredictable, life is unpredictable, a job loss, a health scare, or a temporary market crash can shake even the most disciplined investors. If your portfolio is structured to generate regular and dependable cash flows, that paycheck becomes your ultimate safety net. It depends on the smart allocation into the right passive income streams. This is not the same as chasing dividends or buying high-yield dividend stocks. What we are talking about is a deliberate structure, instruments, and strategies designed to make your wealth not only grow, but also that pay you back month after month and quarter after quarter. Think of it this way. Your SIPs and growth funds are what take you to financial independence. These passive income streams are what let you stay financially independent. They ensure that your 1 crore is not just compounding quietly in the background, it is also working for you actively. So in this video, we'll break down 5 of the most effective passive income ideas that retail investors in India can actually use. Now let's start with our option 1, the OG rental income. When people think of passive income, the first idea that usually comes to mind is rental income. The logic is simple. You own a home or a flat, you put a tenant in, every month money flows into your account. But in recent years, rental income has started to get a bad reputation. Modern finance influencers often point out that the rental yields in India are just 2 to 3%, maybe 4% at best. Even stock market veterans say that. On the surface, they are right. But if you buy a property worth 1 CR, you may only get 20 to 30,000 in rent. That looks like a poor return compared to equities or even corporate bonds. But the way this argument is framed misses the bigger picture. Rental yield is not static. Yes, in the first maybe 2 to 3 years, the yield would be in the 2-3% stage. Property prices appreciate over time and so does the rentals. In India, most rental agreements build in a 10% escalation every year. A house that earns 20,000 a month today can very realistically be earning 40 to 50,000 within a few years. Over a 10-year horizon, the rent from a good property often ends up matching the EMI you once paid on that loan. So that is when rental income transforms from just being just a side cash flow into something that genuinely resembles like a second salary. But you know what? It's high time to get a little creative with rental income as well. Let's move beyond the traditional idea of finding a tenant. Rental income has become far more flexible today. Instead of settling for a fixed long-term lease, you can get creative. An obvious option is to convert your property into an Airbnb. The beauty here is that you don't even have to manage the bookings yourself. There are agencies and operators who take care of the listing, the cleaning, the guest management, while you just provide the property and collect a much higher return than a standard lease. Another option is co-living spaces. With the rise of students and young professionals in metro cities, apartments can be rented out room by room rather than a single unit, often fetching you a significantly higher monthly return. You can also look at commercial leasing on a small scale, such as renting your property for boutique offices, coaching classes, or even as a studio space. These arrangements often pay a premium compared to standard residential leases. Number 2, corporate bonds. For investors who do not want the day-to-day volatility of the stock market, bonds provide a simple promise. Lend money to a company and in return collect interest every year. The returns here are very attractive in the sense that it is better than FDs. Depending upon the type of bond and the credit quality of the company, you can earn anywhere between 8 to even 13% annually. That kind of return when compared to a savings account or even fixed deposits immediately stands out. The best part is that you have full control over the risk you want to take. If you are extremely conservative, you can choose AAA rated or AA rated bonds issued by India's largest corporations. These may offer slightly lower yields, but the risk of default slightly gets managed. On the other hand, if you are comfortable taking on higher risk for higher reward, there are lower rated bonds that pay significantly more. It is almost like having a menu of passive income options where you decide the balance between safety and return. Another big change that has opened up this market to retail investors is SEBI's new rule. Until recently, corporate bonds required a large minimum ticket size, often running into lakhs of rupees. This kept most ordinary investors out of the market, but today the minimum size has been brought down to just 10,000 rupees. That single reform has made the bond market far more flexible and accessible for retail investors. You no longer need to be an institution or an ultra high net worth individual to earn passive income from India's biggest companies. And unlike real estate, there is no property tax, no tenant issuers, and no maintenance headaches. Your bond simply sits high in your demat account and pays you interest on schedule. Just like FDs, you can choose bonds that pay you interest monthly, quarterly, or annually. The difference is the return profile. When most fixed deposits today pay you around 6 to 7%, corporate bonds give you somewhere between 8 to 13%. Now let's talk about a third option, SLBM, stock lending and borrowing mechanism. Now let's talk about an asset class that most retail investors have never explored, yet it can quietly put extra cash in your pocket without you selling a single share. This is the stock lending and borrowing mechanism, or SLBM. Here is how it works. Suppose you're a long-term investor holding shares of companies like Infosys, HDFC Bank, TCS in your demat account. Now these shares usually just sit there until you decide to sell. But traders in the market often want to borrow these shares for short selling or arbitrage. Through the SLBM framework, you can lend your shares to these traders for a fixed fee while still retaining the ownership. At the end of the lending period, the exact same shares are returned to you along with the fee you earned. In other words, your shares remain your asset, but during the time they are lent out, they generate an additional income stream. Think of this as earning rent on your stocks, much like you would do on a flat of your own. The return profile depends on the demand and the stock in question. For very liquid large cap stocks, the lending fee is usually modest, perhaps 3 to 6% annualized. But for certain mid-cap or high-demand counters, the fee can jump to 10% or more. On the risk side, the structure is tightly regulated by SEBI and managed through clearing corporations. Your shares are always backed by collateral from the borrower, so the risk of losing your shares is extremely low. The only real risk is that during the lending period, you cannot sell the shares, since they are temporarily out for loan. So this works best for long-term investors who are anyway planning to hold the stock for certain months or years. Now what makes SLBM exciting is that it creates an extra layer of passive income without adding new capital. If you already have a long-term portfolio, this is the way to squeeze out an extra 3 to 5% annually in addition to dividends and capital appreciation. Over time, the additional yield compounds into a meaningful difference. For investors building a portfolio that can send them a paycheck, SLBM is one of the hidden gems. It is underutilized, but once you understand the mechanism, it becomes a natural extension of your existing holdings, turning ideal stocks into income-generating assets. Now the next option is REITs, Real Estate Investment Trusts. If rental income is the traditional way of earning from property, then REITs are its modern simplified cousin. A real estate investment trust pools money from investors and uses it to own, operate grade A commercial real estate. Tenants like Microsoft, Google, or Deloitte pay rent to the REIT, and that rent is distributed back to investors. For retail investors, this is a game changer. You don't need 50 lakhs or a crore to buy a flat. With just a few hundred rupees, you can own a fraction of a premium office parks across cities, and unlike direct property, your payouts are regular, liquid, and transparent since REITs trade on stock exchanges just like shares. Now let's look at the rest of the profile. The returns. REITs in India typically yield around 6 to 7% annually, distributed quarterly, and in addition to this, there can be capital appreciation if the underlying property value rises. When it comes to their expenses, the operating costs of managing the properties are taken care of by the REIT, which is the trust. As an investor, you don't deal with the maintenance or tenant issues. Now, when it comes to safeties, REITs in India are tightly regulated by SEBI. They are required to distribute at least 90% of their net distributable cash flows to investors. This ensures steady payouts and reduces the risk of your fund managers holding back your income. Next comes the transparency. SEBI regulations also mandate regular disclosures of occupancy rates, rental escalations, tenant profiles, and financial performance. This makes REITs far more transparent than direct property investments. Of course, there are risks. If commercial real estate demand drops or vacancy rates rise, payouts can fall. Interest rate movements also impact REIT valuations since they compete with bonds as income instruments. But compared to owning a single apartment and relying on just one tenant, REITs spread the risk across multiple properties and multiple tenants. We're talking about the last option, which is the post office monthly income scheme. For investors who want the safety of government backing, is the post office monthly income scheme, or popularly known as POMIS. Here is how it works. You deposit a lump sum into the scheme for a fixed tenure of 5 years, and in return, you receive interest payout every month. It is almost like creating your own pension plan. The current interest rate is around 7.4% a year, which is higher than most fixed deposits and very competitive given that the scheme is backed by Government of India. The payouts are credited monthly into your linked savings account, giving you steady cash flow to cover living expenses or to reinvest elsewhere. Now let's look at the investment limits. For an individual investor, the maximum deposit is 9 lakh rupees. For joint account holders, the limit rises to 15 lakh rupees. The scheme is also flexible in terms of liquidity. While the lock-in is about 5 years, you are allowed to make a premature withdrawals after 1 year with a small penalty. That makes it suitable for conservative investors who still want some access to their money. POMS is especially popular among retirees, but even younger investors can use it as a stabilizing pillar in their portfolio. So that's it, guys. These were our 5 options. Please tell us in the comments if you like them or there are any specific options that you would personally like to add. Subscribe to the channel because we'll be bringing more such videos in the future. Thank you so much.
Investments in debt securities, municipal debt securities, securitized debt instruments are subject to risk including delay and/or default in payment. Read all the offer-related documents carefully. For detailed calculation of YTM, please visit our website invest.aspero.in.